Nearly 1 year on the job, SEC Chair Paul Atkins is leading a major shift in how the agency approaches regulation, crypto, and the broader markets. Joining us right now at the table, SEC Chairman Paul Atkins. Good morning to you.
Good morning, Andrew.
So it's been a year in the gig now. So when you started and where you thought you'd be now, what do you think?
Well, a year goes by quickly.
Yeah.
Andrew, so, but we've made huge progress, I think. I promised a new day at the SEC when I came aboard, and we've pivoted from the old practice of regulation through enforcement and the opaqueness of the agency, as it, for example, with crypto, as you mentioned, that was job one, to focus on that. And so basically, we're instituting a strategy that I'm calling our ACT strategy: advance, clarify, and transform. So advance meaning modernization of our approach. So rather than fending off new innovative types of technologies, we're embracing them. And so to make them so that we'll bring them from offshore, where people fled, to come back to the United States to really work on their products. And then second, to clarify things. SEC was very opaque as to how it would approach crypto and other things. We've clarified it with the CFTC. We had an interpretative release with focusing on defining tokenized securities versus other digital assets that are commodities. And finally, to transform, to focus on making our rule book fit for purpose so that we can then make IPOs great again and embellish and enhance our.
Well, let me ask you about the IPOs great again, because this is probably going to be a huge year potentially for IPOs.
Exactly.
SpaceX, possibly OpenAI, Anthropic. The question is whether you think that there's a big enough market to actually absorb some of these big companies.
Well, I think so. When you look at what's happened over the last 30 years, we have half the number of public companies as we had 30 years ago. And so where did that go? That went into the private markets. And so right now, what used to be a B round, what's a B round now, used to be an IPO when I started off as a young lawyer here in New York working on IPOs. And so now people go public at C and D rounds after that, and they're huge companies. So if you look at the things that are in offing now to go public this year, those are huge companies. And for the most part, it's for liquidity, because you have a lot of employees who now have shares and they want liquidity. They want a valuation that's true and set daily, hourly, minute by minute in the public markets. And so that's why public markets are so important. But if we can get younger companies going out to actually try to raise their capital in the public.
How do you do that? How do you get companies to
come to
market sooner?
Well, we have basically three approaches we're doing. One is the total cost and the complexity of our disclosure system. So that's what I hear all the time from would-be CEOs of would-be public companies that are staying private. The complexity of it, the apparatus you have to build to keep up with it. Secondly is the vexatious litigation. In the past, the SEC has been very opaque as to what it would allow as far as public companies going public with respect to whether or not mandatory arbitration would be permitted or fee shifting. And then finally, the weaponization of corporate governance by politicized shareholder activists adds another element. So those three things really stand as impediments, I think, for people going public.
Let me ask you about something that's probably not an impediment, but there are questions about whether it could have a manipulative effect on the market. So SpaceX likely to go public in June, and this exchange where we're sitting, the NASDAQ, apparently will change its rules around the QQQ, which is effectively its own index, which typically used to wait to be put into the index, and will be put in, SpaceX in this case, almost immediately, which will therefore force effectively anybody who is a QQQ shareholder to buy the stock, which will, by default, push the price of that stock up. As somebody who sits in your chair, what do you think of that?
Well, every market has its own products, and there now is competition building for the Qs, for example. So it's really for the market to decide if there's manipulation around that. I think as far as what goes into an index or not, I mean, as long as there's disclosure, and I think that's for the market to decide.
But in some cases, some people look at that and they say the market's not deciding, right? They say two things. One is that these exchanges, this exchange and the New York Stock Exchange, have these different indexes. They're now using the indexes to attract business for themselves, right? Because they're collecting a separate fee. So to be here on this exchange, then they have their index fund as a separate thing, and the market doesn't decide, right? Because you're already locked in.
Yeah, well, so again, that there are other instruments to compete with the Qs, and if people think that the index is no longer indicative of...
You're saying that the market could decide insofar as people could just decide they're not going to own the Q, and that
exactly,
and that would be how you'd think about the market deciding what takes place.
Pivot this, because people want to have an investment that basically represents the market, S&P 500, spiders, all of that. They all came about because people wanted an efficient way through an ETF to have something that represents a broad base of markets. So with respect to the Qs, the same thing. And if they think it's no longer representative of what they want to invest in, then they can find there are other things now coming along that are basically wanting to focus on competing with the Qs.
Right. Let me ask you a question about enforcement and how you're thinking about enforcement today. One of the headlines we see all the time is you see the president make remarks and the market moves. And oftentimes we see headlines the next day that actually there was somebody or a group of people who seemed to get in on the trade, if you will, prior to the president's comments, but typically very closely related. Are you investigating that?
Well, I can't talk about any particular matter, but just say that investor protection and focusing on market manipulation to stop market manipulation is very important to me, and obviously to the SEC as part of our remit for investor protection and for having orderly, fair, and efficient markets. So that is in our DNA, and so with respect to some of these prediction markets and the contracts that are on them, the event contracts, most of that is on the commodity side, the Commodity Futures Trading Commission, where my former colleague Mike Seelig is now chairman there. So I know that's important to him. I know that and with respect to securities markets, obviously insider trading and market manipulation is very important.
Would you, though, investigate people who are either in the administration or other people in Washington who could have access to this? I only say this because there have been so many instances. Look, the president makes certain comments on social and others, and the market moves in big ways. Much more so if you actually go back. Someone did a look back at different presidents. I mean, this president is unique in terms of his ability to, frankly, move the market. And it appears almost every time that there is some instance of trading prior to it.
Right. So
and in terms of the credibility of the markets, how you think about that?
Well, things like that are disturbing, and again, I can't talk to any particular investigation, but we are examining that area. And these prediction markets, it's they are the traceability of the transactions, is there. And so let's just say that between the Department of Justice, the CFTC, and us, we're focused on that. Jay Clayton is here in the Southern District of New York as U.S. Attorney. He and I have known each other for years. We talk a lot, regularly, and then ad hoc about issues. So
you mentioned prediction markets. Interestingly, your predecessor, Gary Gensler, was interviewed in Barron's recently. I don't know if you saw this article. It's fascinating about whether prediction markets should be able to allow people to effectively bet on sports. And he said that when he was also at the CFTC, he said there was never any conversation about sports. He said that no senator back in the day, had sports been mentioned, would have ever voted to allow the rules that have been put in place for that to happen because so many of those states already had rules in place. What do you make of that?
Well, that's being tested in court. There are a bunch of lawsuits out there in almost every different circuit of the U.S. And so I'll let the court sort that out. In New Jersey, there's already been one decision in that regard. So the states and other Native American tribes are challenging that. That is not in the main a part of our remit as far as securities go. That's much more event contracts like box office receipts. I mean, there is a precedent for that on the CFTC side. With respect to if it impinges on a securities issue, like if it's equivalent to a binary option, yes or no, will company X make its quarter or something like that. That's more on the securities side where our jurisdiction comes in.
And then I just wanted to ask you about these semi-liquid instruments in the context of private credit, for example. There are public. They look like stocks. However, you can't necessarily get your money out because there can be these gates of up to 5% you can get out at any one time. We've seen this with Blue Owl and some of the others. And what you think about the disclosure requirements around that? Do you think that the disclosure is sufficient today, not sufficient today? Should they be called semi-liquid instruments? I've heard people say they should be called illiquid instruments so that people know up front that if you need the money and you want the money, typically that's actually when it will be illiquid. We're talking about the private markets generally, not really public. Some of these are closed funds or interval funds, as we call them. So it depends. We're on this also. Our examination division is looking at disclosures in this area. But again, these are private markets. Generally, normal retail people are not necessarily exposed. If they are, then that's there are all sorts of different. Those markets should be more open to a broader investor base.
Well, right now, we, the Treasury Department and the Department of Labor, are working together to focus on these issues around the private markets and whether or not normal people, retail folks, as we call it in the industry, should have access to that. I think if that happens, and there is a proposal that the Department of Labor has put out, there have to be really strong guardrails around that so that, for example, for 401k plans, that trustees have guidelines as to what is an investment that they should and could put their beneficiaries' money into. So it is, they're private markets. They're more opaque than the public markets. So I think we have to proceed cautiously, and there is pressure just from the general economy on some of the private companies, like on the private credit side, where some of these funds have put money. But anyway, so we're looking into it.
Paul Atkins, a year in. Thank you.
Well, thank you.
Appreciate it. It's good to see you.
Great to see you all.
You bet.
Thank you.